Why the heck is Warren Buffett sitting on $347 billion in cash while markets keep hitting all-time highs? Doesn't he want to buy something? Come on, Warren, buy something. No, Warren doesn't want to buy anything. To put that in perspective, that's more than the entire GDP of Portugal or New Zealand. New Zealand! Is Warren just out of touch? The old man's losing his edge. Or does he see something we don't? Maybe the bull market is about to pop. Maybe we're in the biggest bubble of all time. Maybe. We're just too drunk on green candles to notice the warning signs. So stick around, because what Buffett sees might not just impact the stock market, it could blindside your crypto portfolio as well. You see, Warren Buffett isn't called the Oracle of Omaha for nothing. His holding company, Berkshire Hathaway, it's a beast. It has outperformed the S&P 500 by a staggering margin over the last decades. Since 1965, Berkshire's shares have skyrocketed 5,502,284%. That's compared to 39,054% return for the S&P 500 in the same period. That's insane. That translates to 19.9% compound annual growth for Berkshire, nearly double the S&P 500's average of just over 10%. Not too bad for a company that started as a struggling textile mill back in 1965. And this wasn't just about riding bull markets, whatever. Buffett has consistently outperformed even during rough patches in the markets. In 1998, near the peak of the dot-com bubble, the S&P 500 posted a strong 28.6% gain, but Berkshire Hathaway still beat it with a massive 52.2% surge. What's the secret sauce here? Well, maybe he's just lucky. Maybe, not quite. In 2001, Warren Buffett told Fortune magazine that he uses a simple but very powerful metric to gauge market valuations, and he called it probably the best single measure of where valuations stand at any given moment. Worth paying attention to, coming from one of the world's most successful and rich people. That metric, now widely known as the Buffett indicator, the ratio of total market cap to GDP. Right now, that indicator is sitting near its highest level in history, flashing potentially a massive red warning sign. But it's been at that level for a little bit. We're in a bubble territory with massive central bank interventions. But what the hell is a Buffett indicator anyway? It's actually pretty simple. You take the total market capitalization of all publicly traded US companies, basically the combined price tag of the entire stock market. Then you divide that by the country's gross domestic product, or GDP. In other words, it compares how much the market is worth to how much the economy is actually worth and how much the economy is actually producing. If the market cap is way higher than the economy, well, that's a signal of a potential bubble scenario. If it's lower, that might mean stocks are undervalued currently. Now, Buffett said this ratio cuts through the noise. It shows whether the market is actually grounded in reality or if it's just floating on delusions of its grandeur and pure hype. And right now it's floating at over 209%, meaning the valuation of the entire US stock market is more than twice the size of the GDP or the actual economy. It's like walking into a store and seeing $30 toasters and paying $70 because you're convinced it'll start printing waffles made of gold. It's an interesting analogy. Anyway, sure, maybe it will. But odds are you just overpaid big time. The problem is that those stocks can remain at a very high valuation for longer than people think. But before we get into all that conversation, guys, you're trading these cryptocurrency markets, and guys, guess what? The dudes over at Femex just dropped one of the most aggressive offers I've ever seen, and it's made for real traders like you, okay? Deposit $1,000, get $200 back. Deposit $10,000, get $999 cash back. Deposit bonus, go all in with $15K. You'll bank $1,299 cash back money. That's crazy. That's straight up money in your account, okay? And here's the kicker. You'll also get upgraded to VIP level 2 straight away, instantly slashing your trading fees by 50% on spot and 40% on futures. This is an insane limited time offer that's available worldwide. It means anyone, anywhere, that's you might need a VPN in some cases, can sign up to Femex today. So links down below, go check it out. Don't miss out. Again, this is a limited time offer, so lock it in. Now, aside from Buffett's nifty little indicator there, let's look for some other confluence like the Shiller PE ratio. To understand it, we need to back up and take look at and talk about the regular PE ratio, or the price to earnings ratio. It's a basic tool that investors use to gauge whether a stock or the entire market is expensive or cheap. Valuations have been pretty crazy, especially for tech. People put insane valuations on tech, just put that out there. But you just divide the current price by the earnings from the past year. The average PE ratio for the market is around 20 to 25. A ratio below this range could suggest a bargain for a particular stock, while a ratio significantly above this range could suggest an overpriced stock. Simple, right? But there's a problem. Earnings can swing wildly, especially in recessions. Stock prices may fall, but earnings usually fall even harder. That can inflate the PE ratios and make it look like stocks are actually expensive, even when they're kind of cheap. Right when they're hitting a bargain, you might see the PE ratio skewed, let's say. So the regular PE sometimes flashes a fake red light, scaring investors away when in fact they should be buying. And that's where the Shiller PE comes in, because it's also called the CAPE ratio, short for cyclically adjusted price to earnings. And it was popularized by Nobel Prize winning economist Robert Shiller. And it solves that false signal problem by actually diving in and looking at the average earnings over the past 10 years, adjusted for inflation. So think of it like this. If the regular PE is today's weather, the Shiller PE is the climate trend. It filters out the noise, the hype, the panic, the BS, and it gives you a much more stable, big picture view of the market valuation of things. Historically, the Shiller PE for the S&P 500 averages around 16 to 17. At the peak of the dot-com bubble back in 2000, it hit a wild and record 44. We all know how that ended. During the Corona beer pandemic, it reached 38.6, and the market didn't do too well in 2022, did it? In fact, 2022 was a bloodbath for stock markets. Today, we're at 37, near historic highs. Still below the dot-com peak, still below the Corona peak, but we're uncomfortably close to massive levels here, and we're climbing. And this could hit a new high. We could go to 50, for example. Things get crazier than you think in a bubble. Okay, this is the AI crypto bubble. When both the Buffett indicator and the Shiller PE are flashing red at the same time, though, maybe it's not just noise. Maybe it's a bit of signal that things are getting overheated in the market, a signal that we could be entering the later stages of the game. Doesn't mean we can't go for years more, but just later stages, okay? So what does this mean for crypto? Well, Bitcoin's come a long way since 2009, and Wall Street's in big time. They're rushing it even faster. Treasury companies are buying. They're buying the treasury companies. People are buying ETFs. Sovereign states are stacking sats. It's bullish for sure. It proves that Bitcoin's evolving into gold 2.0, a digital store of value. But here's the catch. A lot of that Bitcoin sits on corporate balance sheets right now, often bought with some kind of leverage, aka debt. If the market tanks, when the market tanks, as they always inevitably do, these companies could face margin calls and be forced to liquidate their coins. In fact, especially for altcoin treasury companies, I think this is going to be true. They'll trigger a cascade of panic selling. We'll also have things like rehypothecation and fraud getting exposed at the same time. It'll probably be a crash worse than the FTX crash this time around, or maybe as worse as bad as, Anyway, it's not just going to be crypto firms, but public companies that are going to be the ones to be defaulting this time. But, and this is a very, very but, bubbles can go on a lot longer and be a lot bigger than you think. Just because the Buffett indicator and the Shiller PE are high now, we're in the AI bubble, okay? And things get way crazier before the bubble pops. Not saying NVIDIA is a good buy right now. It's a $4.5 trillion market cap stock. I mean, who the hell is buying NVIDIA right now? But things can get crazier. That's the thing. Bubbles can last longer than you expect. Your job right now is to ride the wave higher, much higher, and sell before the horrific crash, because horrific crashes always come. You know they do. It's part of the market cycles. Hundreds of billions are going to be dumped from ETFs and treasury companies back into the market, and prices are going to crash horrifically. On the flip side, that panic will be a gift for the prepared, as long as you take your profits along the way. Smart money is going to scoop up all that cheap Bitcoin just as fast as it's dumped. You know they will. For retail investors, the playbook is simple. You either decide to hold through all the chaos or stay liquid, take profits on the way up, wait for blood in the streets, re-enter positions, and make shit tons of generational wealth. Just like Warren Buffett would do. He'll buy when the valuations are cheap again. You watch. Sure, his indicator could be wrong. The Shiller PE ratio may not matter. None of this stuff's perfect. The AI hype might keep the markets floating for a lot longer than people think. Their average bull market should last another 2.5 years at least. A mega cycle? Who the heck knows? But Buffett has beaten the market for decades. Are you really going to bet against him? Thanks for watching.